So, what if your crypto could do more than just sit there in a wallet? You know, the whole idea of passive income, making your digital assets actually work for you. It's one of the biggest hooks in the entire crypto world. Today, we're going to pull back the curtain and see how it really works, the crazy returns it promises, and yeah, the hidden dangers that can turn that whole dream into a total nightmare. I mean, that's the ultimate dream, right? Making money automatically 24/7 without lifting a finger. Well, in the world of decentralized finance, or DeFi, this isn't just some fantasy. It's a real thing for a lot of people. But the real questions are, how on earth is that possible? And what's the catch? At its heart, passive crypto income is pretty simple. You're just putting your assets to work. The two main ways people do this are through crypto lending, where you kind of act like a bank, and something called yield farming, where you're providing fuel for these decentralized financial machines. Both can make you money, but trust me, they are very different beasts. All right, so let's get into the nuts and bolts. First up, we've got the most straightforward method, crypto lending. Honestly, if you've ever had a savings account, you'll get the basic idea. It's just kind of like a savings account on steroids. It's a really simple cycle, just 4 steps. 1, you deposit your crypto onto a platform. 2, someone else comes along and puts up their own crypto as collateral to get a loan. 3, they pay interest on that loan, and, here's the good part, that interest goes to you. And 4, when they pay the loan back, you get your original crypto back, plus all the interest it's been making for you. It's basically old school banking, just rebuilt for the digital age. Okay, and this is a big one. Don't get lending mixed up with staking. They sound similar, but they're not. With lending, your money comes from a borrower paying interest. With staking, you're actually locking up your crypto to help secure the entire blockchain network, and the network itself pays you a reward for doing that. So the two big differences are where the reward comes from, a person or the network, and how tied up your money is. Lending is usually more flexible. Staking often means your assets are locked up for a while. So if crypto lending is like a savings account, then yield farming, well, that's like becoming a high-stakes trader on Wall Street. It takes the same basic idea of providing your assets, but it cranks everything up to 11. More complexity, more strategy, and yeah, much, much higher potential rewards. So let's talk about strategy, because this is where the allure of passive crypto income really kicks in. We're talking about annual percentage yields, or APYs, that can make the returns from traditional finance look like a joke. You've really got a whole spectrum here, and it all comes down to risk versus reward. You can play it relatively safe with stablecoin farming, aiming for a pretty solid 5 to 20% return. Or you can get a bit more adventurous, using big name tokens like Ethereum, and shoot for 10 to 50%. And then there's the wild side, leveraged farming. That's where you're borrowing money to amplify your position, chasing absolutely insane returns of 200% or even more. But there is always a but. And in crypto, let me tell you, it is a very, very big one. Those incredible, mind-blowing returns, they don't just appear out of thin air. They're what you get paid for taking on some serious, and often really misunderstood, risks. This is the part of the story that doesn't usually make it into the flashy ads. And the risks come in all shapes and sizes. You've got platform risk, the code has a bug, or the platform gets hacked, and poof, your funds vanish. There's market risk, a massive price crash liquidates everything, and of course, borrower default risk. But beyond all those, there's a quieter, more sneaky danger that most people miss completely, an economic risk that's built right into the reward tokens you're trying to earn. As these researchers point out, probably the most insidious problem is that the very token you're earning as a reward might be designed to fail from the start. The whole system can be rigged against you because of something called tokenomics, basically the economics of the token itself. I mean, just look at this breakdown from a real-world project. Only 37% of the tokens are actually for the public, for people like you and me. The other 63%, that goes straight to the team, the advisors, and the early private investors who probably bought in for pennies on the dollar. And so what happens? Well, those insiders are on a schedule where their super cheap tokens get unlocked over time, and when they get them, they sell, flooding the market. All that selling pressure can absolutely crush the token's price, making the very rewards you're working for worthless. You see the problem? You risk becoming the exit liquidity for the insiders. And on top of all that, there's this really weird, head-scratching risk called impermanent loss. Here's the crazy thing about it. You can actually end up with less money than if you had just held onto your assets and done nothing at all. It happens when the prices of the two assets you deposit move too far apart. The protocol has to rebalance, and in the process, you can lose out on a ton of the upside. It's wild. Okay, so with this absolute minefield of risks, what are you supposed to do? Well, it's not about trying to avoid risk completely, because that's impossible. It's about being smart and managing it. So here's a quick playbook on how to think about this stuff. First up, and this is probably the most important rule of all, borrowed from professional trading, the 1% rule. It's simple. Never, ever risk more than 1% of your total investment money on a single idea. In a market this crazy, that rule isn't just helpful, it's how you survive. And before you put a single penny to work, you have to do your homework. You have to be your own detective. Ask the hard questions. Has this platform been audited by anyone legit? Do I actually understand all the fine print? Have I looked at the tokenomics to see who really owns this thing? And for goodness sakes, am I putting all my eggs in one super risky basket? This is your absolute first line of defense. So where does that leave us? Is it all promise or all peril? The thing is, the promise is real. You absolutely can earn passive income with crypto. But the peril hiding just under the surface is just as real, and it's way more dangerous if you choose to ignore it. When you get right down to it, it's both, isn't it? This is an incredible new financial frontier, full of opportunity. But it's also a digital Wild West, full of scams, hidden traps, and huge risks. The real key to surviving, and maybe even thriving, isn't about chasing the highest possible return. It's about understanding the game you're playing before you sit down at the table.